We review hundreds of opportunities each year and ultimately close on only 4%. 70% of our originations volume each year comes from the portfolio. The originators desk kill approximately 50% of the opportunities that they see.
Success in private credit investing means capital preservation across business and market cycles. Simple, but not easy. It's not simply a matter of investing in unlisted assets. In practice, private credit value creation occurs across a full investment life cycle in which each step is vital to a successful outcome. Here to take us through exactly how it happens is Shannon Fritz, Deputy Chief Investment Officer at Antares Capital. So what are the core principles that have guided Antares through market cycles?
Our core principles have really been centered around credit and relationships across borrowers, sponsors, investors, as well as our employees. 70% of our originations volume each year comes from the portfolio. This is a significant advantage. We know the borrower well, we know the management team well, we've seen it perform, and allows us to move quickly and confidently on those opportunities.
Explain how relationships with equity sponsors are built and maintained over time, and how does that translate into high-quality deal flow?
We have built a reputation in the industry and with our private equity sponsors of reliability, consistency, and trust. To put in numbers, we evaluate hundreds of deals each year and ultimately close on only 4% of new opportunities. In many cases, our sponsors want us involved in the transaction and oftentimes positioned to help us lead the transaction because of our trusted and consistent and reliable experience over 3 decades.
How does leading most transactions impact your ability to drive deal flow and monitor the portfolio?
There are very few private credit lenders who can consistently structure, underwrite, close, and manage portfolios on a scaled basis. Lead arranger status is critical for early and active portfolio management.
Talk about the advantages that accrue through portfolio incumbency.
Portfolio incumbency is a significant advantage, especially in a scaled and diverse portfolio. We have many borrowers in our portfolio that have been borrowers for 5 years, 15 years, up to 20 years. And this longevity and consistency is rare in the industry. And ultimately, these strong borrower and sponsor relationships reinforce strong deal flow, which drives strong portfolio construction. It's a virtuous cycle.
What principles guide your underwriting and portfolio construction, and how do you ensure resilience across market cycles?
Diversity has been and continues to be a key tenet. Diversity across borrower, sponsor, and market. Within a concentrated portfolio, 3 to 4 underperforming loans or disappointing exits can have a material negative impact on that portfolio. In a diverse, scaled portfolio, it will have a much more muted impact.
What is it that differentiates the underwriting process at Antares?
We have over 30 years of underwriting first lien private equity-backed loans. We have very strong retention, so we hire in at the analyst and associate level. We benefit from retaining and attracting top talent due to our market leadership, our collaborative culture, our tremendous deal flow, and senior leaders across our business that are also industry leaders. Our senior credit leaders have over 20 years of experience underwriting deals at Antares.
How do you assess genuine value in a company versus what you might call window dressing, using EBITDA add backs as an example?
Our teams are developed to critically and independently think. And our teams independently assess all aspects of an opportunity: the product differentiation, the competitive landscape, the sector, the financial performance, as well as add backs. And our team will critically look at each add back. There are times when we will have a different view on EBITDA than the sell side. And that's okay. We may still really like the opportunity and think it makes sense. But importantly, we come up with our own independent view of each aspect of the opportunity.
Walk us through the initial triage of a deal.
It starts with the originations team. Once an originator believes a deal warrants staffing from the underwriting team, it goes to our screening committee, which consists of senior credit and originations professionals. And what we're looking for, and what we've always looked for in a borrower, are market leaders with differentiated products and services.
Explain to our viewers how originators and underwriters work together.
It is a very collaborative process across originators and underwriters. Originators are responsible for sourcing the deal, and building and developing and managing those private equity sponsor relationships. Underwriters are responsible for deep dive diligence and independently assessing the credit. Our originators, almost all of them, have come from the underwriting team, which is a differentiator. They have meaningful credit experience and backgrounds that really aligns early on in the process and is a critical point of building trusted, advised relationships with private equity sponsors to be reliable and consistent upfront.
So once a deal is closed, what does active credit management look like in practice?
As lead arranger on 90% of our portfolio, we have direct access to both management teams and sponsor teams for financial and business updates on a regular basis. While documentation terms are, of course, very important, private credit really benefits from trusted sponsor relationships and smaller groups of private credit lenders that are all relationship lenders and like-minded. If a loan is underperforming, we have a 20-member workout team, one of the largest and most tenured in the industry.
Finally, if you could tell wealth advisors and their clients the single greatest value proposition for private credit in a portfolio today, what would it be?
One, the private credit asset class has proven itself. It has proven its resiliency, attractive returns, and less volatility than other asset classes for 3 decades. Secondly, it's critical to select the right asset manager, an asset manager with deep sponsor relationships to really drive deal flow to allow the selectivity, as well as tenured and experienced team who has proven to manage through multiple cycles.
Shannon, thank you for walking us through the private credit investment lifecycle.
Thank you. Pleasure to be here.